must admit it's the first time I've seen this room today. It is a beautiful one, but I flew in from Europe last night, and obviously, like many of you, I've been rearranging my flights, my hotels, where my dog is staying, where I don't even know where my family is. So it's an interesting time, at least with respect to the weather, but also I think an interesting time in the world of FX, and obviously I'm very pleased to be here today, and thank you for coming. Now, one reason that I haven't seen this room is I have been traveling around recently, and I remember when I landed in Hong Kong, I was greeted by a new set of headlines with respect to the U.S. Department of Justice investigation into the FX markets. Another round, if you like, of layoffs, whether they're voluntary or not, on behalf of senior traders in the industry. Just the latest in such things. But I will tell you what actually bothers me the most, because neither I nor ITG, believe me, have any particular opinion as to the legal actions or even the actions that might have generated the lawsuits. But what actually struck me was some time ago, roughly 18 months, when in the United States, there were actually 2 lawsuits that were dismissed by judges on the East Coast here. And the reason for the dismissals were pretty much the same. And indeed, the lawsuits themselves smelled very much like the headlines today imply. In other words, the notion was that somehow the custodians were not giving the best prices. They were not fulfilling certain obligations that at least were assumed in this respect. And when the lawsuits were dismissed, on the one hand, had to do with J.P. Morgan. They dismissed the lawsuit against J.P. Morgan for giving worst prices of the day. And the grounds for that was that the judge thought that, first of all, there is no best execution obligation. All right? This certainly hadn't been settled. As a matter of fact, for most of you probably know, but in the United States, I mean, FX is not even an asset class. This is not legally sanctioned, at least in some ways. And that this judge actually thought that all the information was available in public databases, and indeed on trade confirmations. Now, I've been looking for these public databases for a long time. I personally haven't found them, and those of us who trade in any asset class know that trade confirmations are not exactly evidence of much of anything, except the fact that someone said they got it done. In the second case, it was actually very similar. It was a suit vis-a-vis BNY New York. And once again, the notion was that the board of directors there was absolved of any complicity in anything relating to execution of FX trades. That any decision they might have made to ignore this, actually in the opinion of the judge, was nothing more than, course of business, right? It was not necessarily an unsound business decision. Now, the reason that bothers me more than the lawsuits that are currently swirling around and all the investigations, because I do have a view with respect to the fix that is perhaps a little bit different than some, is that fundamentally, they are basically telling us buyer beware. All right? And I don't think this is anything new in this market, but it has now actually just raised the issue of relative transparency and the idea that people maybe should start to look at what's going on in their own, frankly, financial best interest. So we've spent a fair amount of time trying to shed a little light on the subject. Obviously for both commercial reasons and with respect to at least our own feeling that every market needs a certain amount of transparency to operate. I am not the type of person who believes that complete transparency is perfect for everything. On the other hand, actually getting some idea as to what, say, the cost of liquidity is, some idea as to how the trades are being executed, perhaps at least offering some choices with respect to how, when, and why one would execute through the course of the day. Now, I'm basically going to tell a few stories today to just illustrate this kind of increased transparency that I believe is currently available, not just through people like myself. I think you know, the world is certainly coming around to this. But the way we approached it starting some time ago was fundamentally to try to put together a series of 17 sources of tradable quotes. Now, it's important that these were tradable quotes. This is in, let's call it quasi-real time, all right? So minute by minute, second by second. And what we have done with these tradable quotes is essentially to aggregate them into a series of what you might call 24-hour limit order books. In other words, with 17 quote streams at different deal sizes, we can actually create the analog of a synthetic limit order book. And from that, we can conduct the thought experiment, if you like, as to what the spread would be, what the cost of liquidity would be for any given deal size as one worked down the book. Now, obviously, you can do this in several different ways, and some of it is admittedly a bit abstract. So, for example, that bottom line, all right, so this is an example from, for order size up to 200 million US. The line that's running along the very bottom says something like super consolidated book, all right? Now, that is from all 17 sources. So the thought experiment, I'm afraid, is a bit heroic in that case, because essentially it's a little like we talk about in equity markets. In other words, the ability to actually hit the order book simultaneously. I should say, in that case, you're hitting all 17 sources simultaneously, and the price that you will get for liquidity then just depends on that virtual liquidity, all right, as though you could hit every one of those 17 sources and you work your way down the book for any given deal size. Now, working your way down the book is important because, as many of you know, the book actually isn't that thick at the top. In other words, for something like euro-dollar, yes, you can see anything, say, up to 3.5 million, all right, at the touch. But for almost everything else, this is really capped out at about a million US. And as you go down the book, however, there's actually an awful lot of liquidity available. Certainly, in most cases, up to roughly 300 million. In some of the minors, that obviously will be a bit less, you know, maybe more like 50 to 100. And it takes, on average, roughly 12 to 15 price levels, all right, to actually reach all that liquidity, all right? So your average price as you work down the book is basically what's represented here for every deal size. So that bottom piece, that one is, as I say, abstract at this point. I mean, there are companies, for example, I saw, although I didn't have a chance to talk with them, I saw a booth by Integral, all right? Integral is certainly trying to make headway into the idea of actually being able to access liquidity like that. And eventually, I think this market will become a little more equity-like in the sense that we will be able to. But right now, you must consider that a lower bound. So if you believe those prices, right, that cost of liquidity for every deal side is small, you would be absolutely correct, all right? It is really an abstraction. The next one above, we can perform a slightly different thought experiment. What would happen if for any deal size, right, as you work your way down, you could simply hit the best quote at every deal size? And as the best dealer, right, it's always going to be the best dealer in this case. I'll come to the ECNs in a moment. And suppose you could hit that. Well, interestingly enough, and perhaps this is certainly part of the argument for big dealing, the cost in that case also is extremely low. All right? But even this source of liquidity really isn't feasible. All right? In other words, we're talking about a dozen dealers here, and hitting the best one, all right, for any given deal size at any given moment in time is still a piece of technology that, to the best of my knowledge, really has not yet been developed. All right? We're just a little bit, we're not quite there. So then we come to the next one. all right? What is the next one? The next one is the average dealer book. Now we're getting a little more feasible, all right? So what I can do here is say, all right, I have 12 dealers. I will simply look at the average quote, right, for every single deal size. Right? I will then aggregate that into a book, and from that I will derive the cost of liquidity in terms of the size-adjusted spread. Now the numbers start to look a little bit, let's say, more reasonable, all right? Because that's a thought experiment that actually is much closer to reality. In other words, the notion that on average you could indeed reach the average dealer, all right, and get an average price that might be representative of the tradable quotes in the market. So one can do this for every time of day, certainly for every deal size, at least in this case up to 200 million. And I think at that point things kind of stop except for something like euro dollar. But we can go one step further. In other words, the closest thing that the FX markets have really to equity market structure are these 5 ECNs, right? 5 electronic markets that are this combination of request for quote and limit order book structure. So that curve is at the top. All right? In other words, you can certainly ask the question, what if I could somehow sweep the ECN book without ever talking to the dealer? All right? In other words, what liquidity would be available at that point, and what would it look like? And interestingly enough, although the scale, I'm afraid, doesn't really contribute to understanding here, is that for deal sizes in many of these currencies, certainly in the majors and in some of the minors, if you're looking at deal sizes roughly less than, say, 3.5 million US, the ECNs are actually doing better than the average dealer. In other words, the liquidity in those books is actually pretty cheap for small deal sizes. And I do emphasize the small deal sizes. I mean, they are, as most of you know, relatively new and still working at, at their contribution, if you like, to market structure itself. So, from these, one could look at many things, and I thought I'd just give you a sample, all right, a couple of examples, since these were supposed to be cases in some sense, as to exactly what that might look like. In other words, what you could actually see, what you might actually learn from this type of construction. So the first one is very near to my heart, since we certainly started our legacy is in equities, and that is equity-linked foreign exchange transactions. Okay, so in other words, large mutual funds with global reach that are actually having to do a certain amount of conversion, right, every day in order to reconcile their equity book. So what I did here was something very simple. We have a very large comparative database with respect to transactions across literally 200 buy-side firms, as many as, say, 300 brokers servicing those firms. And I picked out a sample of the top turnover, all right? And I'm able, through the database, just the way things are recorded, to actually differentiate between what would require conversion and what would not. At which point, on a day-by-day basis, I can calculate what the average cost of the FX transaction is, right, using these book data, right, that give me the cost by deal size. And here we're talking about, on average, for any given one of these firms, certainly doing on average between $100 and $150 million worth a day, no problem. Peaks as high as $550 million a day. So these folks are very active. Now, obviously, I do not know exactly how they do the FX. All right, notice that in this data set is hidden from me. This is not from transactions data on FX. Rather, it is from the transactions data on equities, with the idea that I can actually pinpoint the currency transactions. But to save you from too much staring at little bars, let me put it this way. If you take a look on average at these firms and you think about them getting a relatively good price, that's a technical term, all right, during the day, then it's going to cost these firms roughly $14 million a year in just liquidity cost, right? Just the cost, just paying the spread at these various deal sizes to get it done. Now, even if I remove the very worst prices of the day, because even in this market, obviously, we don't really have a 24-hour day, but let's just suppose you were getting prices that were similar to those observed by Russell and Record Capital Management some years ago, then that number rises to $41 million a year. Now, in anybody's terminology, this is big money at this point. And the one thing I would point out is the big money is one part of the story. The spread between 14 million and 41 million is another part of the story. In other words, how you execute that transaction, right, in terms of timing and deal sizes, right, whether you break it up, whether you aggregate it, and so on, actually has an effect that is covered somewhere in that 13, 14 million to $41 million spread. All right, so there's a lot of room to move there based on the cost of liquidity calculations that are available. Now, the next thing I did was something just for fun. I sort of looked at the World Cup, and there's going to be a certain time constraint, so I'm not going to be able to tell all the stories here, but for those of you who are football fans, you know this is the largest sporting event on the planet. And the European Central Bank actually paid attention to this. They were actually concerned about how this affected the equity markets. And so they did a study on the 2010 World Cup. They were looking at what happened as people watched the TV, and were finding results that really amounted to the fact that for the home markets, volumes were down by as much as 55% relative to the average during the games. People just stopped. And indeed, at least by their lights, there was some dislocation in that market. Now, in my case, I would just like to show you what you can see in terms of this data. This is the game between Italy and Uruguay. So the first green bar is the beginning of the game, all right? Then we have the halftime beginning, the halftime end, and the end of the game. So here, we're looking at volatility. We have our own forward-looking measure of this. And volatility dropped below the 5th percentile in the first half of the match. All right, so people really were slowing down at this point. On the other hand, as the game went on, right, when you got to the end, there was a huge spike in volatility post-match. As a matter of fact, this spike is bigger than observed during, say, FOMC meetings where Bernanke used to make pronouncements. In other words, that actual spike is almost a zero probability event. My point is not so much that it's a zero probability event, but it is now observable, all right? And along with it came the fact that post-game, for the euro-dollar, the cost of liquidity also spiked above the 95th percentile, all right, on a historical basis. Now, for those of you who might vaguely have remembered this incident, this is because there was actually the beginnings of a short squeeze, all right? Short squeeze was actually in the pound. I think the euro was collateral damage as things turned out, because there was another game between Costa Rica and England, right? This is the one that eliminated England in the end. It was a draw. You saw the same basic behavior. Volatility drops below the 5th percentile in the first half, all right? So people basically stop for all intents and purposes. As a matter of fact, the limit order book indeed dried up to a certain extent. And you saw exactly the same spike in volatility immediately post-match, right? This is at the point when the short squeeze actually became evident, right? And it happened really in the last 20 minutes of this game, which were the interesting 20 minutes as it turned out, and no one was watching. So once again, here I just show the prices. I mean, it's not terribly interesting. The cost of liquidity also spiked up at that point. And then in Mexico, all right, this one was a little bit different. It makes a slightly different point. Simply, again, what you can actually see. Through these types of data, you can even see the participants in the market, right? One can compute at least a measure of concentration of dealing in any given currency at any given time of day, along with the cost of liquidity. And it was very calm during the game. There was really nothing going on. The level of the order book at any given price was fairly stable. But right at the end, and here, June 13th, I honestly don't remember the news event that might have triggered this, but all of a sudden, the depth of the limit order book actually increased by almost 50% immediately. In other words, there were a lot of new entrants, right, into the market for Mexico, all right, at the time. So the moral of the story is largely that you can see these things now. All right, I mean, for football fans, there's something to look at. It actually is a contribution in the same way as the European Central Bank. We can see that people do take their eyes literally off the ball in this case. But the interesting thing to me is that the data that is currently available actually allows for this. As a matter of fact, the data that is currently available allows for this ex ante, not just ex post. So very quickly, I have 4 minutes. I want to say a little bit about the London fix. This is what I call the London fix at a glance. Now, if you look in the top left, I think, to you, all right, that is a volatility chart. There are 3 spikes in volatility here. All right? One, the first one, when U.S. economic news is typically announced. All right? The second one, when options expiration, right, takes place in terms of time of day. And the third spike is the fix itself. Okay? Now, you move to the right, what do you see at these 3 times of day? Well, for the first 2, you actually see a sharp increase in the cost of liquidity during those time periods. All right? This makes perfect sense. All right? The cost of liquidity, the volatility goes up. Cost of liquidity goes up. Those spreads basically widen at every deal size to get through that short period. But that third spike is actually downwards. Whereas for the London fix, the spreads collapse. This is a well-known phenomenon. In other words, those that talk about so-called manipulation of the London fix point this out constantly, that actually the cost of liquidity is lower, right? Not higher, even given the burst of volatility, all right? And you can certainly see in the bottom, there's sort of a little bump there, all right, in terms of the volume that's actually traded at that time, all right? All that we know. So how does that sort of work into all these stories about so-called manipulation? It creates a lot of ambiguity, to tell you the truth, because certainly the economic theorists have been at work. And there are actually very old papers about this type of auction that more or less say it's not so much. And the reason you might see the spike in volatility and yet the collapse in the spread is that it is the larger buy side as well as the sell side dealers that are all racing, right, to get that last price, right, for their own reasons. And that actually drives the cost down. Now, the problem is that the race itself is something that people haven't thought about. They've been focused on the so-called manipulation of that last price. And as you see, the cost of liquidity is actually pretty small. On the other hand, if you look across currencies that are traded there, I'll summarize it in the following way. In expected value terms, it costs you roughly 3.5 basis points just to participate in the fix. And the reason for that is that there is roughly a 20% probability in any given currency pair, all right, again, on average, grand averages here, 20% probability that you will lose 17 basis points. All right, so if I average that across everything and I just have a single number, 3.5 basis points just to participate in the fix. It's this run-up, right, and you can actually see it in the volume, right, the reversion, right? You get that bump, right at the fix, and there's another bump right afterwards, all right? That's everything actually being, let's say, recalibrated, if you like, after the run-up to the London fix. So, with 30 seconds remaining, I want to give you a shameless plug, all right? But it will not cost you a penny. This shameless plug is that we actually do believe, and perhaps this is a personal thing of mine, as I started to look into the FX market, something that I had written papers on when all I had was indicative quotes long ago when I was an academic, it has really occurred to me that there's some usefulness in putting out this information in some usable form, giving people an idea as to what's going on. So I can tell you that for those that are interested, if you contact us, we will be very happy to supply you with a mobile application that at least for 20 of the 50-odd currencies that we look at will actually give you this cost of liquidity by these times of interest during the day, as well as the volatility that goes with this. We do this by currency pair. We certainly now benchmark it, although the screen doesn't show, against Big Three, Commonwealth, European, Asia-Pac, and so on and so forth. I myself have actually found it a very good, let's say, explanatory device when I talk to managers, especially in the United States. So as I say, it's a shameless plug, but it is absolutely for free, and I'm definitely exactly 48 seconds over time, so I will end it here. Thank you very much.